So the first now we just try to recap from the previous lesson what we have done last week, right? And we discuss about the interest rates of the deposits and the effective interest rates, right? Now what is the we took an example to explain that interest rate of the deposit mean normally a published interest rate, right? For normal published interest rate. And what is an effective interest rate mean? Basically we are talking about the effective interest rate is the interest rate usually calculated on with the compounding figures, right? So that's a difference, but this is very applicable for more than 1 year deposits, right? So what is the theory we have learned how to calculate the effective interest rate and the interest rate. Now say for an example, if you say 1 year fixed deposits, normal annual interest rate is equal to effective interest rate. Now say interest rate is 10%, annual interest rate is 10%. For 1 year deposit, effective interest rate is also 10%. Right? Now suppose you say annual interest rate per your savings account, right? Savings account, and usually for 3 months, 6 months like that for your annual interest rate 10%, but for 3 months rate it should be the effective interest rate is but more than your annual interest rate. That's the first. Now say 10%. So if you are taking 3 months, your interest rate is more than 10% effective interest rate, right? Suppose your annual interest rate for your 5-year fixed deposit is around 10%, right? But what is the effective interest rate? Definitely for 1 year is less than 10%. That's a principle. We have done some question on that. Okay, I think you will remember that. Okay, right. Then we discussed investors. Right, we discussed investors. Under investors, we discussed risk and return. Now, higher the risk, higher the return. Right. That's we discuss, and we also categorize our investors basically based on their risk appetite for 3 types of investors. One is risk averse, other one is risk neutral, and other one is the risk seeking, right? These are the 3. So what is the difference between risk averse, risk neutral, and risk seeking? So risk seeking person is going to take additional risk and expecting a high return. Risk averse customer is basically, unless otherwise he's not going to get a fixed permanent amount, he's not going to invest. The risk neutral mean he's going, if the interest is going up, accordingly his risk appetite also going up. So we discuss these 3 type of risk last week, right? And what we need to know, why we learning all these things, we need to look at it, what sort of products, what sort of financial products they are going to purchase based on their risk appetite. And then we discuss some of the instrument. What are the instrument usually the investors going to invest? So there, of course, we discuss government bonds. What are the government bonds? We call them as usually the treasury bills and treasury bonds. And then we discuss the difference between treasury bills and a treasury bonds, right? What are the similarities and what are the differences? We discuss treasury bills are basically 1 year financial instrument and short term 91, 182 days and 364 days, and bills are purchased on discount, right? Remember, and bonds are usually long term, therefore we call them capital market instrument. So going from 2 to 30 years period, the interests are getting usually semi-annually, right? So these are the some of the characteristics of treasury bills and treasury. Both are gilt-edged securities issued by the Central Bank of Sri Lanka on behalf of the government. Okay, and then we further discuss about the repurchase agreement. Now today we are talking about SDFR and standing facility lending rates are basically on repurchase agreement. So what is repurchase mean? The one customer or person A, or maybe investor one, sell his treasury bills and treasury bond to another person, maybe the lender, and as a collateral, and get the some money, right? Get some lending that B is giving to A. What is the agreement? He will going to repurchase the documents, have give it to the lender on a future date and an agreed price. So therefore, agreed price is the repurchase price, the repo price, and repo price is more than the difference between the buying and selling price is the repo price. So we will discuss in greater length all these things. And then further we discuss about the stocks. So we discuss what are the benefit of stocks, what are the type of stocks, what are the return they are going to get, what type of people are going to investing in stock market, right? And then we discuss corporate bonds or corporate debenture on that. And then what are the features of a corporate debenture, why corporate debentures are issues, and things like that. So we are going to do a small question on that and corporate debenture, right? And then we discuss about commercial papers. Now, commercial papers are short-term in nature, usually issued by credit-worthy customers, right? So, high risk product, right? And then we discuss about the financial derivatives, and then under that we discuss over-the-counter markets and exchanges, and then we discuss type of financial derivatives, forward contracts, future contracts, and options, right? And mind you, these things are, you suppose if you are sitting for all subjects, especially for commercial and the commercial banking and survey, those are two compulsory subjects. All these subjects also you are learning these products. Now we need to look at it, why we are learning again. That's an advantage, right? Because why you select financial clients management as an optional subject, you have a benefited from things you are learning from other areas as well. Now here we are look at it from client's point of view, financial client's of view. Why financial client, or why investor, why depositors are invested this instrument, why especially for investors are investing this instrument, why customers are involving in this type of products and services. For that, we need to understand the, the characteristics of this instrument. That is why we are learning here. So we have to look at it in a different angle from customer's point of view, right? Now, can you remember we discussed the questions are usually framed. We are going to do some more questions today based on what are the features? So what are the characteristics of, say for an example, corporate debenture, for an example, what are the characteristics? Then we are going to look at who are the target market, who are the type of clients who are going to purchase this or invest money in this, right? So we need to identify. Then basically we are look at it, what are the advantages or what are the benefits customers going to get it or investors going to get it by purchasing or investing money in debentures, and what are the benefits to the issuer, that means for a bank or any other institution. Then the next point is what are the risks faced by customer going for a debenture, what are the risks faced by the institution who are offering debentures. These are the format every product we need to look at it. So we will do some more things, right? In the then we'll discuss about the structured finance and that asset-backed securities. I told you securitization, and we are trying to sell the products. Receivable, we are going to sell it, right? Things like that. I'm not going to touch much more on this. And then we discuss about the unit trust. Unit trust means collecting small money and in 100 rupees notion, and then build up a big capital. And there are some companies or fund management companies, unit trust companies, are invested this pool of uh, candidates or the investors' money in for other business places, invest there and get some return, and that return unit trust holders will get a benefit. So that is how what we have discussed, right? Okay, now we are today from this point. Before moving to little bit more, so I'm going to just to explain another investment, right? Of a type of investment we call venture capital, right? Venture capital. Now, venture capital means funds made available for startup firms and small businesses with an exceptional growth potential for that organizations to go in the future. Right now, say for example, what you mean by a venture capital, the investors are invest their money in a startup firms. That what do you mean by startup firms? Mean just to come up, just to begin their firm. That means now say one small guy, young small guy, have a fantastic innovative idea. So, but he don't know how to. He don't have a capital to start the business. He can't start the venture, but he have a fantastic idea, right? So he must be not having money. For that, the venture capital, that means those investors have give that money to those people, right? So that is why. And for example, for PD mean product development. So some people they have the product but they don't know how to develop the product. So for market research, MR mean market research, or enhancing the technical knowledge know-how, right? That means his capability to further improve and to develop a business plan, building management capabilities. Some of the areas the investors are give money, right? So therefore, venture capital also a financial institution, remember, and act as an intermediary also to mobilize and transfer capital fund from process to need people. Now, what is their transferring? Of capital funds, right? Therefore, the venture capital also some sort of a financial institution, act as an intermediary. You also doing the banking job, but what is very specific? Why they are giving? To whom they are giving? To capital funds for needy people, like as I told you, the SME, small people, small business, and guys. Right? Usually, venture capital is mainly raised from wealthy investors. Now, only the rich investors are invest their money. So one day he become the owner of that particular small business because they are giving the money. Right? Venture capital. I think your handout, this VC is mainly raised from wealthy investors. This is not there. So therefore, please write in your handout. Venture capital is mainly raised from wealthy investors. Now, you know what is venture capital. Remember, venture capital also an intermediary. It's an also financial institution. Why? So they want to mobilize fund from the investors and give it to the needy people, right? So that is the job of venture capital, right? Is a financial institution act as an intermediary to mobilize and transfer capital funds from processes to needy people, right? Okay, now why we are going to learn all these things? You maybe learn these things in somewhere else, but you look at it, there are some questions that come in for. So let's we look at it. Two questions. Now these questions came from non-bank financial institute. Now it is not in your handout, but just look at the your screen, and this is NBFI mean non-bank financial institution, that is 2008. Now even you are not doing the NBFI, but you can answer to this question. Now venture capital is a mainly raised the fund capital is mainly raised from where? From the fund where they are raising. Now you remember I told you VC is mainly raised funds from money from wealthy investors. So therefore, the answer for this is what? wealthy investors, right? Okay. Now we look at it, the financial crisis management. That question came on 2019 September, right? Question number 2019, the last exam, right? Now look at that question. Which of the following is a financial intermediary who helps to mobilize and transfer capital funds from those who possess it to those who need it? Right? Now look at it again. Which of the following is a financial intermediary? Now I'll give you a little while ago the definition of what is financial venture, right? Financial venture or venture capital. So that means financial intermediary who helps to mobilize and transfer capital fund from those who possesses it to those who need it. So the answer is therefore, what is the answer? Venture capital, right? Okay. Right, the answer is venture capital. Right. Now we are moving to another type of investment or sort of investment. This is for life insurance policies. Life insurance policies. Right? Life insurance policies. Now let's look at it. The life insurance policy. What do you mean by a life insurance policy? Right? It is a contract. Now, contract between whom? Contract between insurance policy holder and an insurer. Now, say for an example, you are taking the policy from Sri Lanka Insurance, then you are is an insurer, and the if you take a policy from insurance company, the Sri Lanka Insurance, you become an insurance policy holder. It is a contractual relationship. It's a contract between insurer and the insurer. Now, what is promising to give? Give some designated sum of money, right? He say, okay, I will give you, something happened to you, maybe due to death, life insurance policy, no? Now remember, this is a life insurance. If something happened to your life, or maybe you're permanently disabled, or maybe critically ill, something happened to your life, right? Maybe death, maybe you're still you are living, but you are disabled, or maybe some critical illness. So if you come across with something like that, the insurers promise to pay the designated sum of money, right, to the policy holder. Right, say for example, you got a policy for 2 million, 3 million, like that. The policy holder get that benefit from insurance company. Now, what is the amount, the money the policy holder give it to the insurance company in order to get that benefit? What he's going to pay? He's need to pay premium to the policy company. That means the insurance company. Maybe it's monthly, maybe yearly, maybe quarterly, like that, but semi-annually. That is the agreement between you and the policy insurance company, right? So that is the policy, right? And sometimes this is benefited not only for you. Suppose if is benefited, suppose something happened to you, is your dependent also benefited because of this. That's the important thing. And remember, and life insurance therefore cover financial protections or coverage against the risk of being having some problem to you, right? Now okay, so now insurance policies today are basically marketed as a retirement planning. Sometimes we call it retirement planning, sometimes, right? Okay, and it's also can be used, this remember, your policy, the insurance policy can be used as collateral or security. You can security gives you under give this your security, and you can take some loan against that, right? And that is the collateral purposes as well. Okay, now let's look at it. This is 2017 March and 2018 March also. Now we are trying to answer this question. Okay, now we are going to answer this question. Now, what is chain banks and financial institution? Design and market financial services product to cater to the financial need of a different segment. Outline key features of each of the following financial product. Now, here I put only one. Target customer groups and anyone rest to the customers and financial institution. Right. Now, let's look at it. That question. Right. Now, look at it from in that format what we have learned. Right. Okay. What is the format? First, you need to look at it. Key features. Right. Now, can you write what are the key features or characteristics? Right. Now, we try to answer with our normal standard format. Right. What is the standard format? Characteristics of key features. Right. What are the features? What we have learned? What is that? Insurance. Life insurance is a contract between the first one, the policy holder and insurer. Where, right, insurer promise to pay a designated sum of money in the exchange. You have to pay. The policy holder has to pay premium after death or permanent disability or what? A critical illness. That is the features or characteristics of the life insurance policy. Right? Okay. Life insurance policy. It's not right. Okay, that's the first point. What is our normal second one? We are going to discuss target group. Now remember, every product, now today we are going to do something similar products, right? Target group. To whom you are going to market this product? To whom you are going to market? Who is your target group, right? Now say, for example, you can say adults, right? These are the group. Adults, usually adult persons who have a regular monthly income, right? Or income source to pay monthly installment, right? Now I told you what is the promise we have promised with the insurance company, and what is his in return what they expecting from us? Some monthly payment, right? Maybe for 10 years like that. Okay. Now that is the policy holder. Now maybe any persons or sometimes you see your employer, right? Employer. What? Employer also insured by the employee. And also you need to remember, policy holder no need to have the same person who enter into a contract. Maybe someone can enter into a contract behalf of you. Now, say for an example, if you want to get sometime you for a housing loan or maybe some other loan, so insurance company want to get a life insurance cover for as a security. Why? If something happened to you, the insurance guys, bank will get it from insurance company, right? Okay, so these are some banks maybe. So this is how your target groups, banks, right? Some adults who are having some sort of a capability or have a regular income source to pay monthly installment, or maybe employer or maybe bank to give them a loan. So these are our target group. And then what is the next? Remember the third point, benefits, right? So remember this format is applicable every time, right? That is our benefits. Benefits to who? Benefits to your customers and benefits to the institution, right? Here is the insurance company, here is the customer. So what are the benefits you are going to get to customer? First we look at the customers. What are the benefits you are going to get it, right? Now say as a policy holder you are going to protect, or maybe the dependents, if something happened to you in your life, or maybe you're permanently disabled, or maybe you have a critical illness, that amount what we have designated, agreed upon, so he is having some benefits, right? That's the first benefit, right? Second benefits, I told you, you can use this as a collateral. You can use as a collateral. So therefore policy can be used as a collateral. Second benefit. Third benefits, what are the other things? Apart from this, your insurance amount, what are the insurance companies are now giving? They are giving bonuses, right? And also financial and non-financial bonuses. Can you remember what? Now some finance companies are conducting Savari, right? So people who are having policy, they put a draw and they send you to other countries, or maybe, you know, there are some insurance companies like, for example, Selinco Insurance, Selinco Savari, something like that. So you're getting non-benefits, other benefits as well. Okay, these are the benefits to your customers because of having insurance, right? Okay, then what are the advantages to the financial institution? I mean, to the insurance company, definitely, you know, they are expecting a continuous cash flow generation, right? Why? From where? From customers' premium. The customers' premium, they are getting some uh, some revenue, right? And also it's a long-term commitment. It's a long-term commitment. So they have good funds with them, right? So these are the some of the advantage or benefit from insurance companies are concerned. Now we are going to look at it. What is the fourth one? Risk. Again, right now, if you go on this, so it's benefited for not only for finance management, but also other subjects as well. Okay, what are the risks to the customer? Right. Or risk to the insurance company or institution. Right. Now let's look at it first. What are the risks you are going to face? Right. What are the risks you are going to face? Okay, tell me what are the risks you are going to face? One risk is customer is going to pay. You know, it is a commitment, right? Now, for you, it's a contract. No, you have to pay maybe 5 years, 6 years. Some continuously you need to pay some installment as a premium, maybe monthly, maybe quarterly, whatever. Suppose if you miss any one of these installment, your contract become lapse, not live. So therefore, so you need to continuously pay, right? So your commitment is long term. That's the risk you are going to face, because you paid, say you have a 60 installment, you paid 50 and you're not paid 10, so you're not eligible to get that claim, right? That is the danger you're facing. And also there is some problem, what you call is, we call proximate cause. Now you have to remember, it's very tricky. The tricky in the sense, now you may need to clearly specific what is the insurance you are going to get it, right? So it is not covered, so you're not going to get anything. Now I'll tell you a classic example. In the real life, there's an in Sri Lanka, there's a artist called Granville Rodrigo. He's a famous singer in Sri Lanka. He was, maybe you must be not knowing, but you ask from your parents, they know. So Granville Rodrigo met an accident, right? And was hospitalized Colombo Hospital, right? And while he was taking the treatment, was dead. And his wife has gone to the insurance people and asked for, because he has already got the insurance cover, and he got the asked for the insurance. The insurance company reject the insurance. Now he said, okay, your coverage is not an accident, but you having the accident cover. Now he dead because, not because of the accident, because he's living now. He was died because of some infections while he getting the treatment from hospital, some infections, some bacterial infections. That is the reason to Granville to die. So therefore he is not covered, because he is covered accident. At the accident he has died, yes, you get the money. But while your treatment, you are right because of some bacterial infection where he's not covered. Right, so therefore you need to understand, if you get an insurance cover, you need to get the clear coverage. What is the reason you are going to get? Okay, so right, those are the some of the risks based by then. And another important thing is, most of the time there's a lot of complaints are receiving from the customer's point of view. The insurance companies are not paid what they promised to pay. So those are the risk factors, right? And if another risk factor from the insurance company's point of view, what is that insurance company's point of view, right? So suppose the things, now you die before, right? Now say you enter into a today you got a insurance policy, right? And so, suddenly tomorrow you made an accident, die. So, but you didn't get, you pay only maybe one installment. So insurance company has to bear the cost. So those are the risks to the finance companies, right? I think you understood that part while we learned the life insurance cover. Okay, now we may move into this question, right? Any questions like that, right? Okay, now we are going to discuss annuity. So what do you mean by an annuity, right? What do you mean by an annuity, right? Annuity is a product, what you call is an product, or annuity is a contractual financial product sold by financial institution to accept and grow fund from an individual, and then upon annuitizations pay out of stream of payment to the individual at a later point of time. Now let's look at it very simply this. Now, so some banks have one time maybe added a lot of TV commercials on this. I don't know whether you can remember. Bank of Ceylon has said, then see at a pension then People's Bank had put what you call the flexi plan, right? And then Silver Line earlier came up with the HNB. That means you have to pay certain amount of money, contractual money with the bank. Say you are now 30 years old, right? So 1,000 rupees you need to pay 10 years or 20 years or so, but depend on your agreement, right? Agreement period, right? Now say you're a now 30-year person, so bank was ask you, okay, if you paid 1,000 rupees now continuously from 30 years to 40 years, and then from 50 onwards, when you're little older or maybe 55 years onward, I'll give you that 1,000 rupees till you die. Right? Now that's a good product, no? So this is some sort of a pension product. So this is some sort of we call them as a retirement benefit plan. So this is how a lot of insurance companies and banks are working. Those are we call annuity is a common name like paracetamol, right? So Panadol is a brand name like that. So annuity is the genuine name. So it's a contractual, annuity is a contractual financial product. So you agree to pay so much of money for 10 years or so. From that day onwards, you will get 10,000 rupees till you die. So it's just some sort of a beneficial thing for your rest of your life, right? So a lot of investment plan developed by some finance companies and banks to facilitate. So you can pay these money in a small amount and build up some capital, and that from that capital only in form of interest they are paying. You won't get the capital, right? And but sometimes apart from installment payment, you can put lump sum money. Say for an example, now you got after your retirement you got some EPF, say 1 million or 2 million. So you can put that 2 million into that sort of a annuity product. That 2 million you get till you die. Sometimes maybe say 5,000 or some amount, 5,000, till you die monthly basis. That's depend on the interest rate, and that's depend on the money you're going to put, and also your age, right? The durations, all matters. So these products are, we call them as annuity products, right? Now we are going to look at it. If you issue now, I think you got the point, right? Annuity products is like that, like a retirement plan, like a pension product, right? Like a pension plan, right? Example I quoted to you, future commercial banks, we are having the future. HNB had it, now I don't know whether they're having now. We call Silver Line, right? But still, most of the products are available with the all the banks in Sri Lanka, right? Okay, so now we are going to discuss. I don't know whether it is maybe not in your handout. So therefore, please write down in your handout this point. It is there. Please write down what is meant by longevity risk, right? Longevity risk word, longevity risk. Now, okay, before I'll explain to you what is your longevity risk, right? Let me explain to you what is the average lifetime per person. So we call them as life expectancy. What is average in Sri Lanka's person average life expectancy? How many years is going to live usually in Sri Lankan person? Right, in Sri Lanka, maybe 60 years, 65 years, 70, 75, 80, 90, 95. All Sri Lankans are going to live for 90 years? No, no. So they have experience. There is a normal life expectancy in Sri Lanka is what you call 75 years. We are assuming after 75 is going to die, right? So that is the what you call the normal way. So what is the longevity? Longevity mean the guy who is living more than 75 years. That is the issue. Now first, so therefore we write the definition, right? Okay, please write down the definition. Okay, under that you can write what is longevity risk. Please write under that risk due to living long, L-O-N-G, risk due to living long beyond normal life expectancy. A risk due to person living long beyond normal life expectancy, right? That's the longevity risk, right? What do you mean by longevity risk? Risk due to living long beyond normal life expectancy. Now, we little while ago we discussed about annuities, no? So we enter into a contract, and then after some time, after some day or some period, so you are going to get till you die that amount. So banks, when you're calculating the amount and the interest working on that, they're thinking that they take that assumption that, right, people are going to die around 75. Suppose the guy who is living more than 75, say 90 years, so banks still need to pay that. So there's a 20 years the bank need to pay extra. So, you know, that is the risk bank is going to face because of longevity. The guy who is living more than the expectancy, 75 years. Right? Now you see the annuity products. Why? We are working all the calculation based on the guy is going to live for 75 years. Now problem is banks are just smoothing out. How? Some people are die at 65. Some people are 70. Right? So therefore, advantage we are getting here are offset by the guy who is going to live, person is going to live more than 75 years. Okay, now you know what you mean by longevity risk. Now product like annuity, that's the risk faced by the bank, longevity risk. Okay, now try to answer the question. This was appeared in 2018 March. What is meant by longevity risk? right? You can ask, no, is easily you can answer to this question. So what is the, if you not written down the answer, you can write this one. What is meant by longevity risk? Mean risk due to living long beyond normal life expectancy. Right now, as I explained to you, the banks, when they're calculating their annuity products or pension product, and assuming that the guy who is normally living 75 years, the guy who's living more than that, bank is going to face some sort of a risk. That is the longevity risk. Okay, so you will learn something different also now. Okay, clear? Right. And I want to tell you, if you have any problem, to just ask from me, right? You can ask, so unlock your mute and then ask from me, right? Or otherwise I'll give you a time, so don't wait, don't go home, don't go away from your this thing, because after this lesson, or maybe 5 minutes to 3 o'clock, maybe just close to 3 o'clock, I will open up for you to ask anything from. Okay, I will try to answer at that point as well. Okay, right now, so we go back again to this, right? Okay, right, just look at it again. Now look at it, outline key features. Same thing I will ask from you, whether you can write it down. Now outline key features of each of, this is my model question, right? Outline key features of each of, this is how the questions are usually come. That's good for your client management, as I told you, the commercial banking and serving also. So you are multi-benefited by learning this, right? Outline key features of each of the following financial product, targeted customer groups, and any benefits risk. And this is the format, right? Any questions you will ask. That is why we need to understand the features of the product. So that is why you are maybe learning in a different subjects. All these things you are learning again and again. But so I am look at it from the customer's point of view in my subject, right? Okay, now let's look at the debenture. Right now, what's the feature? So what are the characteristics of a debenture? Now we have learned debenture. I just try to get something to your mindset, right? Okay, what is a debenture? Debenture is a what instrument? It is a debt instrument. It is a debt instrument, right? Remember, it is a debt instrument, right? Remember, it is a debt instrument. Now, usually not secured any physical assets or any collateral. When you are issuing debentures, say for an example, some finance companies, maybe some corporates, right? That is why you call corporate debentures, right? Issued in order to get the capital to your organization or get some money to your business, they issue debentures. So that is why a debenture purchased by investors, right? Thereby, for that, so issuing company or issuing institution, no need of giving any sort of a security, right? So I'll give you your money. Now if you come to a bank, if a customer want to get a loan from a bank is asking some sort of a security, either personal security, or they are going to learn all these securities little time now. So any type of security, some sort of a security. But for debentures, there is no debentures issues. Purely depend on what? The credit worthiness of the issuer, the credit worthiness of the issuing company, right? Some debentures are tradable. Some debentures are tradable. That means you have a secondary market, but not all. There are different type of debentures. I'm not going to touch all these things. You may have something to learn some other areas and other subjects also. Some are called subordinate debentures, like that. Convertible debentures have so many things, some features. There are different type of debentures, but I'm going to look at it, give the key features of a debentures, right? And sometimes you can get a rating for your instruments. You can get a rating for rating agency can give you a rating for your debenture, for your financial instrument. Maybe it's a AAA rated instrument. That means definitely you're going to get the money back, something like. Now these are what you call the characteristics or features of a debenture. Okay, first point. Okay, then who is the target group? Who's going to buy these debentures? Who are usually the corporate customers and some investors, wealthy investors who are having money. Some institutions going to buy. These are your target groups, right? Okay, maybe overseas buyers sometimes, right? So then what are the benefits to the bank, and what are the benefits to the bank, mean the issuer, and what are the benefits to the customer or investor who's going to take these debentures? One factor is, for customer, debenture is a debt instrument. This is usually is going to get a usually higher rate of interest. Again, we won't say interest rate, we say coupon rate. The coupon rate may be again differ, maybe every 6 months, maybe yearly, usually semi-annually and annually, right? You get a stream of income if you have the debenture. Usually debenture may for going for maximum, usually is go for 5-6 years. The time period is not much, is maybe maximum up to 7 years, 10 years max, right? Majority of are less than that. Okay, so these are the some of the advantages. What are the advantage or benefits to the customers? They get a good coupon rate, good interest rate, good revenue, stream of cash flows, and also it can, some debentures are tradable. If you don't want, you can sell it, right? Okay, so what are the advantages to the or benefits to the issuer or maybe the finance company? So it is, if the organizations need to fulfill their capital, they need some capital, and this is the ideal thing. So they can fulfill their capital requirement, right? And also it is a long-term source of fund. Now deposit is a short-term, right? This is a long-term deposit fund, right? Long source deposit fund. Okay, and if you the bank issue this, so banks are not subject to SRR, statutory reserve ratio, if bank issue debentures, right? Otherwise is not. Okay, now some of the benefits of debentures, right? And what are the risks to the customers? So issue is, now what is the risk to the customer? Now I told you at the very beginning, debentures are issued at what? Issued with no any security. So therefore, if that organization, the issuer, that is why I told is depend on the credit worthiness of the issuer. The issuer is not there, so who's going to get the capital back? Right, that is the issue of your risk issued faced by the customers, right? Not guaranteed the capital. Second one, so what is the risk paid by the issuer? So usually you have to pay higher interest to the customers. So that is the one. So likewise, now the products, so financial instrument, what we are learning here, remember, can apply these principles. So you, every time you get an instrument like that, apply this. What are the key features? Who are the target markets who are going to buy these financial instruments? What are the benefits to me as a customer, as to the institution who are issuing, and what are the risks faced by customer, and the all products we are going to do that. So I'm not going to put all things, but you try to learn. Okay, now if you take the annuity, we put it the same thing, no? So right, what is annuity? Is a contractual saving product. Agree to pay certain amount of money, maybe installment or lump sum, and from that onwards you're going to get the stream of money or stream of cash flow till you die. That is the fee annuity listing. Who are the target group? Maybe senior citizens, right? Some young, some parents will take for the children also, right? Insure, and sometimes some employers also try to get this annuity for their employees, right? Okay, so that is sort of a pension scheme, like, so therefore you can use as a pension scheme, right? So what is the benefit to customer? So you have a fixed income source, right, from till you die. That is the advantage to the customer. It's sort of a retirement benefit plan for the customers, right? Okay, so then what is the advantage to the bank? So the issue of annuity, so against long-term fund, right? But you have to pay maybe after 60 years or like that. right? So you have accumulated long-term fund. So what is the risk faced by the customer? What is the risk faced by the customer? And remember, and this is basically a long-term thing, right? So you are going to get the money after you reach your 55 or 60. So you don't know whether the organization is going to exist during that time. So if you're now, suppose you start from 30, 40 years, you are going to get this benefit stream for maybe from 60. Right now you are starting 40, so another 20 years you need to wait no to get the benefit. So whether the 20 years this organization is going to exist or not is an issue. That's a danger. As far as the issue is concerned, the risk what we little while ago learned, what is the risk we learned little while ago about the annuity? Banks are facing, or the issuers are facing, what risk? Longevity risk. Suppose a guy who is living more than 75 years and it is a loss to the organization, right? So any product you can put like this. Okay, now, so up to now we discuss about the depositors, right? Just to recall it quickly, right? Depositors, we learn different type of depositors, savings account depositors, savings depositors, demand depositors, right? And then what else? Demand depositors, then fixed deposit or term depositors, what are the type of products they are going to buy. We discuss the savings deposits, characteristics of a saving deposits, like that we discuss in a greater length, how deposits are imposed to the bank and into the economy and like that. Different features about these products, right? We discussed very early. Then we just completed what? Another type of, now we are in the first lesson, right? What is the first lesson? Type of clients. Now we discuss depositors, one type of clients. Depositors, we discuss all the benefits and things like that. Now you will remember what is the important things we learn under that. About the depositors, we discuss about the debit cards, and then we discuss about what the important thing, what nomination facility. Can you remember? So we discuss some of the points associated with this topic, right? You need to remember all this. Then we investors, what are the things we learn in under investors? Different type of investors, right? Different type of products the investors going to buy, right? Then based on the risk appetite, like that we learn instruments, things like that, treasury based bonds who investors going to purchase, right? Okay, now, so what is the next type of customers then? So we call them as the borrowers. Now we are learning type of clients. Now we discuss depositors, we discuss investors, now we are discussing borrowers, right? So then before that, I just want to tell you we have a different type of customers. No, now different type of customers mean we discussed earlier. We have a retail customers. We have a corporate customer. Banks are having retail customers and corporate customers. What is the difference between a retail customer and a corporate customer? Right now, retail customer is obtain services from a bank for his personal needs, right? Remember, the retail customer mean the customer who obtains some services from bank for his personal needs, right? Whereas the corporate customers, what his job? Obtain bank services mainly for business purposes, right? So we are discussing different type of customers now. So while it is not, but I just want to tell you who is retail customer, who is corporate customer. So banks are usually treating to these two different type of customers. Retail customer who getting the services from a bank for his personal requirement or personal needs, whereas a corporate customer is going to get services from the bank for his business's purposes, right? Remember, okay. So for the bank who are catering to the individual customers are we call what? We call them as retail banking, whereas the banks who are catering to the corporate sector we call corporate bankings. Now in your organization, you have a retail banking sector, maybe AGM or DGM retail banking. Some may have a corporate DGM or AGM or manager, chief manager for corporate banking. Right now you see the difference. So there are different type of customers also you can handle. Right? Usually remember the retail banking clientele is huge. Why? So many retail customers. But as far as the corporate customers are, number of corporate customers are less. So indirectly what we have discussed, we have discussed just what is the difference between corporate customer and a retail customer. Okay, now you know who is the retail customer, who usually get the services from the bank for personal needs. Then who is a corporate customer? He is usually getting the services from a bank to his business purposes. Usually the banks were offering the retail customers facility we call retail banking, corporate banking. But remember, the retail customers are number-wise large, but the corporate customers are number-wise less. Okay, now we are moving to who are borrowers, type of customers, right? Borrowers. Okay, so who is a borrower? Who is a borrower? So you can just write in your handout somewhere who is a borrower. Right, you can just put down some word, right? Borrower. Okay, you can just write down a person or company, write down please, right? Who is a borrower? A person or company that has received money, from another party, with an agreement to pay back with some interest in the given agreed period of time. Okay, right? Just understand. Okay, now we are going to discuss the type of borrowers. Now we are going to discuss type of borrowers, right? Type of borrowers. Okay, type of borrowers. Who's going to buy? Now, without borrowers, what happened? No bank to be survived. Why? Because people who get a loan only, that's a profit to the bank or financial institution, right? So there are different type of borrowers, like different type of depositors. We have individuals, right? Some individual person and come and take the loans, and joint borrowers. Two people are come and ask for the loans. Sole proprietorships, that for individual business guy. Partnerships, private limited liability companies, public limited liability companies, quoted, unquoted, statutory bodies, government institutions, governments, societies, cooperative societies, clubs, NGOs. Now you see so many number of customers you are catering to, from retail to corporate. There are different type of borrowers, right? So we have identified now type of borrowers, right? Type of borrowers. Okay, so those people who need some money, they are going to for a financial institution and ask for some loans. Okay, right. Now let's look at it. What are the purposes they are buying? What is maybe for the trading purposes, some for housing purposes, right? Some people are buying for build a house or construct house, and we are going to discuss later on. And some people are getting a borrowing money for agricultural purposes, maybe industrial purposes, tourism purposes, to build up their small medium enterprises, to build up or to do some money need for micro enterprises businesses purposes, maybe for consumption purposes. There are different type of purposes. So people are borrowing money from the banks. Various reason, various people are buying. Okay, let's look at it now. There are two type of advances. Now in your handout they put advances now, right? You have to put down you can stock it lending. Types of lending is ideal than type of advances, right? Okay, now first two things you remember, there's a place in your direct advances and indirect advances. So we better to talk direct lending and indirect lending. Now, so what are the two types of lending, right? Okay, direct lending mean usually the money or cash is going out from the bank. Now, so suppose a customer comes to the bank, asks for the loan, but bank is doing, bank give the money, right? Cash outflow, cash going out from the bank. So those are we call direct advances or direct lending. Now, as result of the cash is going out from that, it will impact your balance sheet. It is impact your balance sheet, right? So therefore, sometimes we call them direct lending as what? On balance sheet activities, on balance sheet loans. Okay, right. And therefore, bank may face some sort of a liquidity. But whereas the indirect lending is called, it is money, cash is not going out from the bank, but it is an promise. It is a liability of the bank, right? It is a liability of the bank. Okay, let's look at it. These three in your handout, right? In more details. Right, let's look at it. Okay, right, let's look at it. Here you can see, direct and indirect. So you can, right, suppose the lending, the examiner asks you what is the difference between indirect lending and direct lending, right? So you need to understand. Okay, right, let's look at it now. What is here? You can say cash outflow from the bank. First point, cash outflow, right? Cash advance where the bank cash flows out, and therefore can be affect the liquidity of the bank, because money is going out from now. So therefore, bank can. So because it's affecting your cash outflow, sometimes we call them as, right? We call them as on balance sheet. Call them as on balance sheet activity or advance. Okay, right. Here, under indirect lending mean cash not outflow, but is a liability, right? Liability mean what? So if that, now this indirect lending is given to the third party, right, by the bank. Now say for an example, if he is not going to pay your money, I will pay you the money. So I mean bank. If he is not going to pay you, I'll give you a guarantee for you to, I will pay you the money. If my customer is not paid, bank will pay you the money, right? So therefore, it is not implicated because cash is not out from the bank. So therefore, we call them as off balance sheet. We call them as off balance sheet activity or advances, right? Sometime. Okay. So what are the examples? Now in your handout, you can put examples under direct lending. What are the examples for direct lending? Right? All type of loans. All type of loans. What are the all type of loans? Huh? Consumptions loans, personal loan, housing loans, right? Anything you name it, right? Housing loan, consumption loan, any type of loans. Money is going out. And then you can say overdraft. Then you can say pawning. Pawning is not a financial product, say, but okay. Higher purchasing, loan, right? Loan against deposit. Any type of loans you can put as an example here. Right? Money is going out from your bank. Cash is going out from any type of loan, your personal loan, housing loan, consumption loan, project loan, whatever you name it. Then you have overdraft as an advances. You can say overdraft, pawning, and things like that. So, what are the example for indirect lending? Example for indirect lending, we call them as what? LC, letter of credit, and guarantees. Guarantees are what? You can say performance bond and then bid bond. So whatever. So performance bond, right? Also example, shipping guarantees. All are we call them as guarantees, LCs. Because if you not pay, I will pay you. So money is not go immediately out from the bank, but you take the undertaking. That is why I call a liability. Now, so now you know what you mean by a direct and indirect lending. If the examiner asks you, name a customer, following is the indirect lending taken by your customer. Example, you say LC, OD like that. The answer is LC. Okay, right. Now you know what are the two type of lending, direct and indirect, right? So first you can write this and give some example for this. Clear? I've written down. Okay, right? Cash outflow. Here, not cash is not going outflow, but it's a liability. It's a promise to give. Then not affecting liquidity, affecting the liquidity, but he is not affecting the liquidity because money is not going immediately from the bank. So therefore, it's an on-balance sheet activity, off-balance sheet activity. And what are the examples for direct lending? Any type of loan, you name it, any loans. This is we call it letter of credit, guarantees, right? Guarantees may be performance bond, shipping guarantees, right? So somebody is given for another party. Okay, having understood that, what are the factors? Now borrowers are coming. Now borrowers are, what is borrower mean? Get some sort of a loan. Right, now is important thing, but again you are going to learn in more detail when you go to the diploma level, but in your commercial banking also you are going to you are going to learn, but I'm going to touch some of the key points only, right? Okay, what are the factors to be considered before granting a loan? A customer comes to get a loan from a bank, so you want give no. And the loan, right? If a customer comes to a bank to get a loan, is called borrower. Now, what are the factors we are going to look at it to give it to him or not, right? Okay, the first point is that first point we call them as 5 C's. 5 C's, right? 5 C's. Right. First one is 5 C's. It is not in your handout. Please write down this one, right? A small piece of paper, or maybe in your same handout, you can put it somewhere small. I'm not going to talk to you much on this. I'm not going to touch, give you more lengthy notes. In your same handout, you can say factors to be considered before granting a loan. These are things I have incorporated after I send you the handouts, but it's better to learn something also, right? Factors to be considered before granting a loan. So first, maybe look at 5 C's. Some people are already working in the bank. You know what do you mean by 5 C's? 5 C's. C's, there are 5 C's. What are the C's? Okay, first one, character. CHARTER, character. Character. Now, are you going to marry a person without you don't know? No, you're not married, person you don't know. So likewise, bank also try to give a loan to identify the person. So that's the first point, character. Second, capacity. He in a position to pay my loan back. I'm going to look at it, capacity. Capacity. Third, capital. How much? How much they want? Amount. Fourth one, collateral. Security star. See, collateral. What is a collateral is going to give it to me? Oh, what is the security is going to give me because based on that? And the last one is conditions. Last one is conditions. So now this may be, and the present situation after this COVID-19 issue, some factors we are going to look at it may be different now. Sometimes you may look at it his conditions differently, then take a more weightage for different C factors than these factors, right? Okay, character, capacity, capital, collateral, and condition. So these are the 5 C's before you grant this, just to get an idea only, right? Okay, the second factor, what you're going to look at it now is the second factor. You can just jot down. One is the 5 C's factor. Second factor, crib. You can just put crib, CRIB. You know what is crib? We are going to learn later on what is crib, right? Crib we are going to learn later on. Crib means, so we want to find out his credit worthiness. And all sort of things you are going to look at it. That is from the crib report, right? Credit Bureau, crib report. Third factor, you can put under third factor is credit scoring model. Credit scoring model. Credit, CREDIT, scoring model. SCORING, model, MODEL. So what is credit scoring model? Right? And all banks are now develop certain, some model how to evaluate the customers, right? You can just put under that what is credit scoring model in a very one sentence. Under that credit scoring model, you can put this is the methodology, this is the methodology, this is the methodology used by banks. This is the methodology used by banks. This is the methodology used by banks to identify the credit worthiness of the customers. The credit worthiness of the customers. There's a mechanism, right? Model developed by the bank to identify. Right, that's all. Now I will explain to you what is credit scoring model, but you don't want to write down. You just get into your mindset, right? What is this model? How you going to evaluate the customer's credit worthiness? Now under this method, so they have identified different criteria, right? Now say for an example, different criteria mean his personal information, like what sort of a person, young person, old person, married person, pep guy mean, who's pep guy mean? Political exposed person, because risk of giving, right. Then identifies personal information, age, occupation, things like that, right? And also going to look at it, repayment capacity with your past experience. With the crib report is nil, he has not taken loan and is continuously paying, things like that, and you give some marks to that. You give some marks to that, assign scores to that, right? Say certain age, if you are now say for an example, if you are 70 years, high risk, no? Why? He's going to die, no, sometime. So suppose a young guy who's working for organization, his salary is good, no children, married and newly married, like that, based on certain factors, you assign some marks. You calculate all the marks and see, after assign some marks, and you put some some decision based on that. So I think you are going to learn on this under commercial banking, but I just give you some food for thought. Right now, what are the factors to be considered? So one is 5Cs, crib report, and third one is credit scoring model. Just an idea. Three. Under that, you have to put three. 3Cs, five Cs. What's the next one? Crib report. Third one, credit scoring model. So banks are using all these models. And one of the elements of 5Cs we discuss, what is that? Collateral. That is what I want to just to talk to you on that. Right. Now, what do you mean by a collateral? What is the best collateral you can take as a bank? Huh? What is the best loan you can give it to a customer? What is the best risk-free loan you can give it to the customer? That also risk, but very easy. One is cashback securities. That means loan against your deposits. Why? I'll give the money, his money, no, not my money. Right? So that's a very, very simple, very easy method of security. What is that? Cashback security. Or, that's the one. Loans against your deposits. So you deposit 1 million today, I may give you 900,000 tomorrow, because I'll give you your money. But you need to recover that money in a 3 years period. But usually that's the best security the bank can take it. Then there are different types of securities. Here we explained to you, I have given you the notes, different type of different type of securities. Based on the type of securities, some banks are charging different interest rate. Right? Some banks, now say for an example, personal guarantee, I mean, is a very risky one, right? But still, we give loans to them, but it's sometimes higher rate. We call movable and immovable sometimes, right? Some instruments are movable, some instruments are immovable and movable. What are the movable? Vehicles, stock in trade, machinery are movable, but immovable means land building, fixed machinery and things like that. And sometimes we give insurance policies. Can you remember? We learned little while ago, or maybe 15 minutes or half an hour ago, we learned what? We learned insurance covers. Insurance policies can be used as securities. Yeah. And treasury bill unit trust, can you remember? Yes. That also you can use. And receivables also can be used as a securities. Matamyaging in the theory, right? Or maybe personal guarantees. I just give you 1C before you are granting a loan to the customer. We look at type of securities. Can you remember? 1C is collateral, 5C is collateral, right? That is why. Because it is very important. And the second important thing is the documentation. When you are granting loan, you may have a lot of documentation. No? You are asked to sign everywhere. Customer also very greedy about taking a loan. He is not look at it anything. Whatever we are telling, they are signing and accepting because he wants the loan. No, right? We put so many conditions and get the signature and short signature. And why? He is don't know anything. He want to get a loan. He said whatever you think to write. Sometimes we asking, give your property also to me. He sometimes he's right. Right? So bankers are not like that. Right? Why documentations are important? Because that is the only legal evidence. So if customers not pay you, so on what ground we are going to file actions? The documentation. Right? So therefore, that is why we have a lengthy documentation, because the legally enforced things are based on the documents. So therefore, that is why we have always we have a legal department in our bank, right? So why that is why we have a full set of rules and regulation, because documentation play an important role, because that is only legal evidence, right? And remember, the defects in documents may be what happened, just lost this entire bank, right? Jeopardize the bank, because loan is the important thing. If you give the customer loan, mean what? Customers deposits. It's not my home money, no, my own money I'm giving as a loan from depositors. So we are responsible for depositors. So therefore, we have to ensure that we are maintaining a proper document. So that is why we need to have a proper documentation when you're granting loans. So these are some of the principles, some of the basics we learn under borrowing. When you're going to borrow, look at the customers, borrowing customers. So we need to look at it type of things. Okay, now we are going to discuss different type of loan products, right? We discuss different type of deposit products. We discuss the different type of investment products. Now we are going to discuss different type of loan products our customers are interested, right? Okay, let's look at it now. Loans. Right, loans, as I told you, is a specified sum of money provided by a lender. So borrower also the same, right? Lender is, in our case, is a bank or financial institution, to a borrower, our customer, on condition. What is the condition? He is going to repay either in installments or maybe advance, or agreed dates and agreed interest of period. Now, I gave you an example for borrower. Who is a borrower? You can just put a borrower is on a condition that is repaid either in installment or advance or agreed dates and agreed rate of returns. Okay, so that's simple as that. So there may be a different type of loans. Some loans we are giving maybe with the secured loans. Maybe sometimes we are not giving with the without secured loan. Is we call clean basis. We'll give. We won't keep any law, any guarantee with us. We just giving you. Right? Okay, there are different type of loans, and there are some loans are subsidized, some are concession. That means, so for example, refinance loans or subsidized loan. Right now, say for an example, recently government introduced moratoriums package, right? And also some working capital at 4% rupees, and those are subsidized. So, right? Clear? And facilities. Okay. Remember this. Now we are going to need to learn a little bit of technical point as well. Okay, before that, please write down this in your handout or in your small piece of paper. This is 2019 March, right? Question number 1. That means 2 marks only. What do you understand by the term loan account in a bank? Now, who is loan account is taken by customers, borrowers. Now, is how banks are giving loans. Banks need to open an account, like savings, like fixed deposit, like demand account. Likewise, banks, when they are granting loans, or a borrower take the loan from a take the money from a bank, so bank need to open a loan account. Now, this question is asking, What do you understand by the term loan account in a bank? Right. So have you written down in your piece of paper? This is questions. So try to write the answer now. Under that, then I will explain to you. Right. You can write down. Right. Before that, I want to tell you something. Loan and advances is an asset to your organization. Right. The moment you give a loan to a customer, you are creating asset. Right? Remember that you are creating an asset. That's just because the loan mean is that receivable things, right? Okay, you can write down under that what you understand by the term loan account. Just simply just put like this: a method of lending money, a method of lending money, right? A method of lending money, a method of lending money. Write down, right? A method of lending money by which a method of lending money by which by which by which the proceeds PROCEEDS with the proceeds being being credit to a CREDIT credit to a current or savings account current or savings account of the customer by creating CREATING by creating a asset asset called 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 loan account. Loan accounts. Right. Now you know what you mean by the loan accounts. Now you may remember some program also, no? Right. Loan account. Right. What do you understand by the term loan account? It is a method of lending money by which the proceeds being credited to a current or a savings account of a customer. But what we are doing, we are creating asset. We call that asset is a loan account, right? Okay, that's some techniques we need to learn here. So I want to give you another small definition. Put down these definitions also. You may come across most of the time. That's called penal rate, right? In lending, you will come across penal rate, right? So we charge penal rate. Now this under COVID-19, central bank has given directions to all the banks not to charge any penal rate from the customers. Now say for an example, you take a credit card, right? If you are not pay, they will charge a penal rate. No, if you are not pay at the specified amount, they will charge you penal rate. Okay, let's define what is penal rate. So please write down. Now I'll give you a small definition for that. Penal rate. What is penal rate? Okay, right. So please write down this definition as well to fulfill full document. Penal rate. Penal rate, right? Under that. That could be charged. Penal rate could be charged. Penal rate could be charged, CHARGED, by a bank on loans and advances. By a bank on loan and advances from a customer, from a customer, during the overdue period, during the overdue period, during the overdue, OVER, DUE, overdue period, full stop. Next point, penal interest rate should be charged, penal interest should be charged, only for the amount in arrears, the amount in arrears, ARR, EARS, amount in arrears during the overdue period, during the overdue period. Then you get an idea about penal rate. Okay, can I repeat it again? Penal rate could be charged by a bank on loans and advances from a customer during the overdue period. Penal interest rate should be charged only for the amount, only for that amount in arrears during the overdue period. So that means, suppose you are supposed to pay 100 rupees, right, today. Now 1 month has gone, you are not just paid, right? Not settling the loan. So I will charge extra rate, extra charge, apart from your interest, for that you are 100 rupees only. That is what you call penal rate. So you are supposed to pay 100 rupees installment, say for 100 rupees during this month, but you are not paid. Maybe you may pay next month. So 1 month late. So for that 100 rupees, you're charging some percentage, depend on the banks. Some rates are now fixed because of this COVID and all sort of things, but that is a normal bank penal rate. Earlier we had only maximum of 2%. Now they have taken out, bank can charge as a reasonable amount. But now again, due to these some factors, government was asked not to charge any penal rate from customers. Okay, right. Now you got 2 points. What do you mean by a loan account and what do you mean by a penal rate? Right. 2 theories, small theories you learn. Okay, now again, so you 3 things you need to write, no? What to do. Right. Now you write again, small thing, right? First loan we are going to discuss with you. First type of loan we are going to discuss with you. Now we are going to learn, we discuss capital, we discuss savings account, likewise, and treasury bill, treasury bond, pledge, then we discuss venture capital, and then we discuss treasury bills and treasury bond, corporate debtors, corporate debentures. Then we discuss commercial papers, unit trust, and all sort of things. Now we are going to discuss the type of products a borrower is going to buy from the bank, right? Okay, first loan is, we call them as term loan. Just put down small, only 2, 3 points, right? Not max, right? Okay, term loans. Term loans. Now, what is the word term? Can you remember we learned term deposit? What do you mean by a term deposit? Another name for fixed deposits. So therefore, the term the name implies is a long-term loan. Is a long-term loan. You can just put, usually the customers need to pay the longer repayments. That means usually 5 to 7, maximum up to 10 years. Just depend on the type, right? Usually longer term, right? Okay. So why people are taking term loans? Term loans, you can say, granted Usually long terms, usually term loans are granted for acquisitions of fixed assets, acquisitions of fixed assets, acquisition, ACQUISITIO, acquisitions of fixed asset, gun, military gun. What are the fixed assets? Land, building, machinery, right? Right. We call them as capital equipments, right? Okay. Again, the term loans can be given to set up new businesses. Set up new businesses, purposes, right? Why we are getting term loans? Customers want term loans to set up new businesses. Second point. Third point. Okay, the term loans are also taken for modernization, maybe expansion, um, or maybe for project purposes, right? Okay, so the term loans can be also taken for modernization, expansion, or projects purposes, right? And last point, you can say, usually, remember, usually term loans are given with a security or collateral, usually collateral. Okay, now understood what is term loan. The first type of loan we just learned. Usually the term loans are given for a longer period of time, usually 7 to 10 years. And purposes of taking the term loans, what purposes? To fix capital expenditure, or that means the fixed assets like land, building, machinery, to set up maybe new businesses, or you want to expand the businesses, you want to modernize your businesses, something like that, or maybe project facilities. So you take the loans. The term loans are usually issued with a security, right? It may be mortgage, maybe a lien or pledge or whatever, right? So the security may be mortgage, lien, so pledge. So we are going to discuss all these three things later on, right? Okay. Now, have you understood the first type of product we learned under borrowers? Term loan. Right. Now with this knowledge, now let's look at it. Can you answer to this 2019 March question? Right. Read the question and think the answer. What may be the answer? This is your exam, huh? Financial Clients Management 2019 March. Question number 1. Right. What may be the answer? What is CapEx mean? Capital expenditure, right? Okay, lending product available for corporate for their CapEx investment would be, what is a lending product out of this? You know that. What is that? Just while ago we discussed granted acquisitions of fixed assets, right? For building lands and all sort of things, right? It's a capital expenditure. So what may be the answer? Answer, as you correctly already pointed out, it is term loan. Okay, right. Now what we are going to discuss, another important type of facility. We call advances. Overdraft, we usually call them as advances. Now, sometimes you may think we say loan and advance. I'm not going to explain all these details, right? Just remember, right? Loan is a longer term. Advance is usually a shorter term, right? Now, overdraft is an advance, right? Type of, is also a lending facility, but it is a short term. It is a short term, yes. Okay, now you having this. Now I'm going to explain to you more than that. So therefore, again, I'll give you more information apart from your note. Please write down some of the points what I'm going to explain to you other than this. Okay. Now you have in your handout overdraft facility. Right. Okay. Now you know, when we're studying about the main feature of a current account, what is the thing we discuss? What is the benefits the customer is having a current account? If they need a short-term funds, they can arrange overdraft facility. So the knowledge you are going to get it, you can make use. What is the first point? Please underline this. Overdrafts are given to current account holders, right? That's the first point. Overdrafts are given to current account holders, not to others. Now say Mr. X is having a current account. Mr. X is having a current account. Just because of he is having a current account, can he get an overdraft facility? That's the question. Now, Mr. X is having a current account with your B bank, ABC bank. Mr. X is having a current account with the ABC bank. Now, question is, can he get an overdraft facility? What is the answer? Yes or no? Right? Just because of you are having a current account, can you get an overdraft facility? So that is the overdraft facility is the bank's idea or bank's property. So remember, overdrafts are given to current account holders who have a good banking relationship with the bank. Remember that word, good banking relationships, right? That's the first point. Sometimes you may have a questions comes, write down short notes. Right, overdraft facility. So what are the things you need to write? The first instance, under overdraft facility, this point. Overdraft facilities are given to current account holders who have a good banking relationship. Just because you have in a current account, it's not necessary to give you a overdraft facility. That's depend on the good banking relationship. Sometimes the overdraft facility can be withdrawn by the bank if you are not having a good relationship. Suppose you're not maintaining your current account properly. Banks are not giving overdraft facility to that customer. So that is why the good banking relationship play an important role. First point. Second point, an overdraft facility allowing the customers to write checks or withdraw cash from his current account up to the overdraft limit approved by the bank. Now, what is that? So, okay, we'll leave it the second point and go third point, and then I'll come back to the second point. Third point is said, what do you mean by the overdraft facility? It allowing you to use more funds from your account balances in a given time. That's important. Suppose your current account balance is having around 100,000 rupees, but you write check for 120,000 rupees. Or you take the cash you can take the cash from the current account also through using your card. So you need to get 110,000, but you're having 100,000. So that is the facility. So that means overdraft facility means you can take more than your current account balances at any particular given point of time. Right. Then I come to the second point. In order to get that 10% or 10,000 rupees more than in your balance account, you need to have an agreement with, usually you need to have a limit approved by the banks, right? Okay, right? So that is a real overdraft facility, right? You need to come to an agreement with the bank. Okay, so I need, if any case, right? In any case, I need some money more than in my current account. So to what extent you give me the loan? Maybe 10,000, 20,000, like that. Okay, third point. Write down the fourth point under this. Fourth point under this. Important points, right? What is the fourth point you can say? ODs are, overdraft are, write down. Please write down. Overdraft are payable on demand. Payable on demand. Payable on demand. Next point. Overdraft facilities. Overdraft are payable on demand. What do you mean by that? Right now, can you remember when a customer, I told you very maybe the first or second day, customer come to the bank, want to withdraw the money from his account, or even for term deposit, even from current savings account. You want to withdraw some money, right? So you say, no, 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 I can't give you the money. So I don't have the money in my counter now. Can you say? Even for a term deposit, you can say you are entering into a contract for 1 year. Now, why are you asking the money? Can you say no? No, still you have to give the money. Then customers' deposits are payable on demand by the who? Bank. Right? Payable on demand by the bank for your savings account or current account. You can't say no. Likewise, think the other way around. Overdrafts are payable on demand. So if the bank asks, you have to settle. Suppose due to some reason, bank is not happy with your transactions, they was asked to please quickly pay your loan taken. Not the normal loans, right? Overdraft only. Payable on demand, right? Payable on demand, not other loans. Now, you suppose you are given a loan for housing loan and you want now money, you go and ask, I need to enter into a 20-year housing loan. You can't go and ask the money, yeah? Right? That is not possible. For only for overdraft, you can have that facility. Therefore, fourth point is overdrafts are payable on demand. Right. Next point. OD facilities. Next point. OD facilities may be secured or unsecured. Secured or unsecured. Secured or unsecured. Now, if you want to get overdraft facility, you can seek there may be a security, you as a call letter you can keep it, or maybe not. The moment you pick the security, interest rate may be less. If you are not have the security, usually the interest rate high, right? Okay, that is we call unsecured mean clean basis. We call them as clean basis. Usually higher interest rate you need to pay, right? Next point, you can just put down this important point also. Overdraft facility under this one you can just write can be used to finance what purpose? Working capital requirements of your business. Working capital requirements. That is why overdraft are usually taking working capital requirements. Working capital requirements. And also any urgent financial needs, and also any urgent financial needs. So therefore, overdraft facility can be used for finance your business's working capital requirement, or any other urgent financial need. Any other financial. Now, you know the purposes of overdraft, right? Can be used to working capital requirements as well as any urgent financial needs. Right. Okay. Write down this point also. Right. Right. You can just put. Now, how you charge the interest rate? Now, for an example, you take a loan, will you? Now, say housing loan. There is some agreed interest rate, right? You need to pay. It's a reducing balance, but for overdraft, you can write down this, and then I will explain. Please write down that. An agreed interest rate. So once you learn this, so you can write any questions, whatever the subjects. If they ask a question about overdraft, any question you can ask, right? Answer, right? And in agreed interest rate is charged in agreed interest rate. Now you need to agree interest rate with the banks. No forgetting, there are some fixed interest amount, or maybe it's depend on the bank, right? You can give a better rate. Rate is charged on the daily debit balances in the account. Daily debit balances in the account. Debit balances in the account. Now it's like this. Now say your current account is having 100,000. So you get the OD facility for 120,000, 20,120. That is the OD facility, therefore 20,000. 20,000. Okay, right. So you receive next day, maybe 2 days time, you receive 5,000 to your account, current account. So then what is the remaining balance? 15,000. So for interest is charging only to that 15,000, not to the full amount. Suppose another 2 days back time, you get another 5,000. So what is the now remaining balance? 10,000. The interest is charged only that 10,000. That is the advantages of overdraft facility, right? Okay. So when the account is received deposits, overdrafts utilized will automatically be settled by the amount of deposit. Clear? That is why. Okay. That's the advantage of deposit. Right? So because of that, if you want, you can use as a revolving credit facility, like a credit card. Why? Now, credit card, you have a credit facility. Now, say for an example, you have a credit facility of, or a credit card facility of, say, 50,000. Right? You go and buy items worth of 40,000. So maybe another 1 week time, you go and deposit again for your credit card, maybe 10,000. Now, what is your credit facility now? Early only 10,000 available. Paying of 10,000, your now credit facility is going to 20,000. So that is why it's called revolving credit. Right. Therefore, the overdraft also, if you agree for a certain amount, you can use as a revolving credit facility. Okay, I think you understood that also. Right. So then you can write down the next point, the most important thing. I told you about the credit facility, overdraft facility. Once you put down everything, so there's nothing to worry. You can ask any questions about overdraft facility for any paper, commercial banking or survey or wherever you ask, right? Okay. Then you can say under this, generally, there are two types of overdraft facilities are aware. There are two types of overdraft facility. There are two types of overdraft facility. One we call temporary overdraft facility, TOD. TOD we call temporary, TEMPORARY, temporary overdraft. TOD we call TOD. Then other one is permanent overdraft facility. Permanent, PERMANENT, permanent overdraft facility. Right? Permanent overdraft. Today you're going to write little more, no? Permanent overdraft facility. Right. Then small note. Again, please write what do you mean by POD. We call permanent overdraft facility. Under that, you just write down POD. Small, 1 or 2 sentences maximum. Right? What is POD? Right. Okay, write down. You can write under the POD, permanent overdraft, POD. You can just put within bracket POD. POD is to mark a limit of credit. Just write down, I'll explain, right? Is to mark a limit of credit, is to mark a limit of credit with the prior arrangement. With the prior arrangement. With the prior arrangement. With the whom? With the bank. With the bank. Bank. in a specific amount, with a specific amount and specific interest rate, specific time, specific amount, and the specific interest rate. Right? Time you can adjust it, but mostly amount and a specific interest rate. It can be renewed periodically, right? Okay, next point under permanent overdraft, secured by a collateral. Usually secured by a collateral. Secured by a collateral. Secured by a collateral, right? That's all. So if you want to get a permanent overdraft facility, you go and ask, okay, this is the, go to the bank and ask, okay, I need, if something happens, so if I maintain my current account, I need to write more checks sometime, the balance is not maybe enough. So what is the maximum limit you can go up to me? So then they say, okay, so I give you a 50,000 OD facility. That is the amount you can use it for loan facilities. Right? Okay, that for that amount 50,000, you may have to make put in some collateral. It may be like your even for your safe your treasury bills, treasury bonds, you can use as a collateral. You can use it your deposits, or rather than a deposit, you can use other insurance policies, share certificates like that. Okay, so now write down temporary overdraft. That means TOD. TOD. Right. Under that you can say cater to your liquidity needs. Liquidity needs at a given point in time. So suddenly you need some cash requirement. This is not permanent. You need quick sometime, you know. I don't want a permanent, but there are some occasional instances I need some facility. So that for temporary overdraft facility. Cater to your liquidity needs at a given point in time. Cater to your liquidity needs. Cater to your liquidity needs at a given point in time. Usually is for shorter period. The TOD are usually shorter period of time, usually for 3 weeks. So that's a shorter period of time. So there's no security. So therefore, I told you earlier, since there's no security, you have to pay a little higher rate of interest. No security, no security. But permanent overdraft, you request for a overdraft security. But in temporary overdraft, you are not asking for security. So therefore, banks going to take a little higher risk. So therefore, higher interest rate charge. Right? So no security. So therefore, usually higher rate of interest charged by the bank. Right. For this also, you may have to have some agreements with some prior agreement with the bank, but you don't want to specify the amount. But you say if there is something happen, so you need to give me this facility, right? Okay, but as overdraft, the permanent one, you have a specific amount. But here you don't want to have a specific amount, but not big, right? It's a very short period. Okay, these are, we call them as generally the two type of overdraft facility. Right. So other than these two type of overdraft facility, are we having another type of facility? Yes. So you can right now all these overdraft facility with the TOD or POD, asked by whom? Bank won't give you. Asked by whom? The customer asks from the bank, I need some facility. But there are some instances, even though a bank, customer is not asking, but sometimes bank will give him overdraft facility. So that facility we call, write down small one, casual overdraft, right? Casual overdraft, right? Write down small note, CAS, casual, UAL, casual overdraft facility, casual overdraft, casual overdraft, CASUAL overdraft. Okay. Now write down under these sentences what is uh, so casual overdraft is a service of the bank. Casual overdraft is a service of the bank service of the bank for the valuable customers, for their valuable customers, without the request by the customers, without request of the customers. Right now, without request of the customers. Second small point, this is provided purely on the, this is provided purely on the, this is provided purely on the discretions, DISCRESION, discretions of the manager. Right now, you see, discretions of the manager. Now that is what you call casual overdraft. Suppose you are a very good customer, you're never asked in your OD facility, and I went through your records. You are maintaining your current account very well. No, never you have problem with your current account maintaining properly. But there are some instances, without your knowledge, maybe you have gone overdraft. Your check is not enough having the money, the checks what you have given. For that, then the bank manager will look at it, the credit worthiness and the relationship with your customer. So bank will initiate a overdraft to a customer without his requesting. That is purely on the decisions of the manager. That sort of accounts, that sort of casual overdraft we call casual. Now, a lot of banks are giving things like that these days. Right now, most of the time now, these under COVID-19 case, the banks managers are giving a lot of casual overdraft, things like that. Now they are in a position to pay back. So what banks maybe convert these things to the normal loans. So that's just something you need to look at. Okay, now I think you learned the importance of overdraft. Okay, you got the full stuff about the overdraft. I hope you understood about the overdraft in very clearly. Okay, so you know what is overdraft, right? Okay, now can you apply this overdraft to this as this, right? Our normal format. What is the benefit? What are the advantages? So what is the features? Risk, benefit to the customer, benefit to the bank, benefits to the customer, and then we look at it. The next one is the importance of risk to the customer and risk to the banks. Right? Okay. So right now, so the time has passed now, but okay. So very interesting to learn. Okay, now I don't know whether now you can ask from me. Have you understood now up to this point? Okay, so don't worry. So we will see you on next Sunday. And also now next Sunday, I just request from you a small thing. Now we have learned overdraft, right? Can you answer to that questions, right? What is the questions? Overdraft. So what are the characteristics of overdraft? Second, right? What is benefits to the customer? What are benefits to the bank? What are the risks to the customer? and what are the risks to the bank. All right. Can you answer that question with the knowledge what you have gained about the overdraft? So we will discuss the answer next time. So try to answer, and then I'll explain the answer. Then you try to see where you are missing. Right. Then this is the best way. Clear? Understood? Right. So we will see you on next Sunday.